Students, let's start with review and solution of ISC boards class 12 2024 accounts examination, which was held on 11th March, that is today. So let's start with this. This is the question paper where the very first question is about admission of a partner. So a partner Ajay has been admitted in the firm of Neeta and Rita, where as per the balance sheet of Neeta and Rita, there was balance of rupees 80,000 in workmen compensation reserve. Upon revaluation, they found that the claim for workmen compensation is of rupees 90,000. So now out of these four, we have to choose the correct option. When the reserve is lesser than the amount of claim, the amount which cannot be adjusted with reserve, that goes to the debit side of revaluation account. So here the correct option is revaluation account would be debited with rupees 30,000. That is this one. You know that in that case means where since all the reserve amount is going to take care of the claim, and that is why no reserve will get distributed among the old partners Nita and Rita. So let's move to the next question. This is second question where a company is there, it's a listed NBFC company, and it is going to enter the bond market. Bond market is the market where you can raise funds in form of debt, that is borrowed funds. So it wants to raise up to rupees 1,000 crores in form of non-convertible debentures, that is by issuing non-convertible debentures. Now, according to the provisions of Companies Act 2013, we have to find the maximum amount that the company will redeem out of its capital. Means if the company raises rupees 1,000 crores in form of bond, that is debentures, then what is the maximum amount that it can redeem of these 1,000 crores out of its capital? Now you know that redemption can be done either out of profits or out of capital. Those companies which are bound to make DRR, that is debenture redemption reserve, of at least 10% of the face value of their outstanding debentures or bonds, they redeem debentures out of profits up to the amount of reserve, that is DRR, made by them. However, in case of listed NBFC, DRR is not required, and that is why this company, that is Credit Access Grameen Limited, has to redeem its debentures fully out of capital because it does not need to make DRR. And therefore, the right answer would be D, that is 1,000 crores. That is, the company would be redeeming its entire debentures or bonds out of capital. So let's go to the next question. I hope you have understood the second one. Now, this is again a question of partnership firm, and at the time of dissolution, okay, what have we have been asked here is how the company will utilize the realized amount from the sale of its assets towards its various liabilities or payments. One of the option is partners loan, second is firm's debts, third is balance of partners capital, fourth is surplus divided amongst the partners in their profit sharing ratio. So the first one is the priority is given to firm's debt. After that, partners loan is repaid. After that, if any balance is left out of the proceeds from sale of assets, then it is paid for partners' capital. And after that, even if any amount is left, then that is divided among the partners in their profit sharing ratio. Right? So the correct answer here would be Q, P, R, and S. That is this one. So this is the correct answer of this question. The next question is about shares. Tulip Limited allotted 45,000 shares of rupees 10 each to the public, and it has not received first and final call of rupees 2 per share on 1,000 shares. And because of that, these shares have been forfeited. Later, 600 of the forfeited shares were reissued at rupees 7 as fully paid up. It means while reissuing shares, the company issued share certificate of rupees 10 per share, which is the face value per share, but collected only rupees 7. But what we have been asked here is to determine subscribed capital of the company. So subscribed capital has two parts, you know that. One is subscribed and fully paid, and second is subscribed but not fully paid. And that here would be it is allotted initially 45,000 shares. Out of that 1,000 it has forfeited and again reissued 600 shares. It means total capital which is outstanding or which is there in the hands of shareholders is 44,600, and that is fully paid. It means subscribed capital of the company is 4,46,000. So the correct answer here is this one, 446. And this 446 is subscribed and fully paid capital, right? Let's move to the next question. Question number 5. So here we have been given assertion that revaluation account is prepared at the time of dissolution of a partnership firm. It is absolutely incorrect. In case of dissolution, we make realization account and not revaluation account. You know that. And the reason says that a revaluation account is prepared to determine net gain or loss on realization of assets and liabilities, assets and settlement of liabilities. Now, on realization of assets and liabilities, what is the net gain or loss? For that, we do not make revaluation account, but we make realization account. So both assertion and reason are false. That is incorrect. So this is the correct answer. Now, sixth question is about a partnership firm where a debtor of rupees 30,000 was there from whom this amount, that is 30,000, was due on 30th June 2023. However, this firm got dissolved on 31st March 2023. So, much before the due date, the debtor cleared his dues at a discount of 4% per annum. So, we have to pass correct journal entry to realize the payment from the debtor. The entry here would be cash or bank account debit to realization account with rupees 30,000 minus 4% per annum That is, the amount would be 30,000 minus 4% of 30,000 for 3 months. Why? Because the due date was 30th June, but the debtor is making the payment 3 months before, that is on 31st March. So for 3 months, he will get discount at the rate of 4%. That is 30,000 minus 300, that is 29,700. So the amount of this entry would be 29,700. Yes. I hope you have understood this, guys. Question number 7. So here a company has issued 9,007% debentures of rupees 100 each at a certain rate of discount, and we have to calculate that rate of discount. Now, after writing off the discount on issue of debentures, the company was left with a balance of rupees 35,000 in its securities premium out of the original amount of 71,000. So earlier, before writing off discount on issue of debentures, the company had trade balance in its securities premium of rupees 71,000, and after setting off the discount on issue of debentures, now the balance left in its securities premium is 35,000. It means the company has issued, the company has used or utilized securities premium of rupees 36,000. That is 71,000 minus 35,000 means 36,000. It means the amount of discount was 36,000 on debentures of 9 lakhs, that is 9,200. It means the rate of discount was 36,000 divided by 9 lakh into 100, that is 4%. So the answer of this question is 4%. Now next question is about claims of a company on a company which have not been acknowledged as debts, and that claim amount is 880.58 crores, rupees 880.58 crores. And these claims include third party claims because of any disputes relating to some contracts aggregating 29.22 crores. It means in the claims of 880.58 crores, 29.22 crores claims are also there which have not been acknowledged as debts by ITC Limited. Now, we have to mention heading and subheading where this item of rupees 880.58 crores would be shown by the company, would be presented by the company in its balance sheet. So the answer to this is, guys, are contingent liabilities and commitments, which is heading, and subheading is contingent liabilities. Those debts which are not, sorry, those claims which are not acknowledged by a company as debts, they are its contingent liabilities. Why? Because there are either some disputes or the case is in a court where the final verdict has not been announced by the court yet. So, answer to this question, that is heading of this item is contingent liabilities and commitments, and subheading is contingent liabilities. Even though you answer it, even though you write in this answer as answer of this question as contingent liabilities only, then also you will get full marks, because usually students are not supposed to know much about contingent liabilities, that is the heading up of contingent liabilities and commitments. So now the next question, this question is again of partnership, where there are two partners, Deepa and Pia, and they are sharing profits and losses in the ratio of 3 to 2. They admit Charu as a partner for one-fifth share in profits. The capital of Deepa and Pia before adjusting the loss of rupees 5,000 on revaluation of assets and liabilities are rupees 30,000 and 20,000 respectively. It is decided that Charu will contribute 20%, 25% of the combined capital of Deepa and Pia. We have to calculate Charu's capital contribution. So capitals of Deepa and Pia are 30,000 and 20,000. And revaluation loss of rupees 5,000 will go to Deepa and Riya in the ratio of 3 to 2, as in their old ratio. It means 3,000 will go to Deepa, because of which her capital will decrease, and 2,000 will go to Pia. So, with this, now the capital balances or adjusted capitals of Deepa is 27,000, of Pia it is 18,000. It means their collective capitals are 45,000, 27,000 plus 18,000. Now the question says that Charu will contribute 25% of the combined capitals of Deepa and Pia. It means 25% of 45,000, which is 22,511 250, is Charu's capital contribution. I hope you have got this. So now, next question. This question is again of a company where we have 8% 1,000 outstanding debentures of rupees 100 each. These debentures were to be redeemed by the company on 31st March 2023. We have to pass journal entry for the amount due to the debenture holders on 31st March 2023, including the interest on debentures due to them. So we have to pass journal entries for amount to be redeemed to debenture holders as well as interest payable to them. So total amount payable to debenture holders is 1,000 into 100, that is rupees 1 lakh. And these debentures were there on 31st March 2022, and they were due for redemption on 31st March 2023. It means for the entire year, interest is payable on the debentures of rupees 1 lakh at the rate of 8%, that is rupees 8,000. So the journal entry here would be 8% debenture holders account debit Okay, it is for the amount due to debenture holders. So the entry would be 8% debentures account debit with rupees 1 lakh, that is 1000 into 100. Interest on 8% debentures account debit, that is rupees 8000 on debentures of face value of rupees 1 lakh at a rate of 8% for the entire year to 8% debenture holders account with rupees 1 lakh 8000. So this would be the entry for this question. Next question is now question number 2, where we have been given balance sheet of three partners, Hari, Jacob, and James, as at 31st March 2023. In the liability side, we have only capitals, and asset side, we have fixed assets, debtors, and bank. Now, on 30th June 2023, Jacob has died. His drawings from 1st April 2023 up to the date of his death, that is till 30th June 2023, amounted to rupees 1 lakh. According to partnership deed, Jacob was to be charged interest on drawings at the rate of 4% per annum. He is entitled to share of interim profits for which his capital account was created with rupees 1,10,000. So we do not need to calculate here his share in interim profits nor the amount of interim profits. It is already given. He is also entitled to his share in non-purchase goodwill of the firm. Firm's non-purchase goodwill on the date of Jacob's death had no value. Okay, it means there is no goodwill at all. Now, final amount due to Jacob by the firm was transferred to his executor's loan account. We have to prepare here interim balance sheet of the reconstituted firm as at 30th June 2023. Now we do not have any profit sharing ratio of Hari, Jacob, and James in this question. It means the profit sharing ratio of three partners is 1 is to 1 is to 1. So here we have interest on drawings, share in interim profits, and there is no goodwill at all. So let's make some calculations and then balance sheet of the firm. So the first thing that I would be doing here is calculation of interest on drawings at the rate of 4% per annum on drawings of rupees 1 lakh for a period of 3 months. Why? Because the drawings were between 1st April 2023 till 30th June 2023. So interest on drawings on 1 lakh at the rate of 4% for 3 months. Since we do not know the date of drawing, we will assume that the drawings were made by Jacob at the mid of these 3 months. So this is 4% and 4% and 1/4 is 4% means 4,000. 1/4, that is 3 by 12 is 1/4, so that is 1,000 and half of that is rupees 500. So this is interest on drawings calculation. Now his share in profits of interim period is rupees 1,10,000. We do not know how his share in profits was taken by Hari and James. So we'll assume that Jacob's share, which was 1 by 3, was taken by Hari and James equally. That is, half of 1 by 3 means 1 by 6 has gone to Hari and 1 by 6 has gone to James. It means there is no change in profit sharing ratio at all. So to give share of share in profits of interim period to Jacob, the entry that would have been passed by the firm is P&L suspense account debit, profit loss suspense account debit to Jacob's capital account. So let's calculate Jacob's capital balance as at 30th June 2023. That is on the date of his death. His capital given to us in balance sheet as at 31st March 2023 is 1,90,000 minus drawings of rupees 1 lakh minus interest and drawings of rupees 500 plus share in profits of interim period 1,10,000. So now his capital balance as on 30th June 2023 is 90 plus 110, that is 2 lakh. So 1,99,500. This is the capital balance. For interest on drawings, also we will credit P&L suspense account and will debit Jacob's capital. For that only I have decreased Jacob's capital by rupees 500, that is with the amount of IOD. So in assets we will have, okay, in liabilities we will have capital accounts of Hari and James, which will not change at all. So it will remain 340 and 220. Now Jacob's loan would be there. With rupees 1,99,500. And the asset side, we will have fixed assets as it is, that is 3,50,000 and debtors of rupees 250. Bank balance will reduce by rupees 1 lakh, that is with the amount of drawing. So now the bank balance as on 30th June 2023 would be 150 minus 1 lakh, that is 50,000. And here we will have profit and loss suspense account. Now profit and loss suspense account was debited with rupees 1,10,000 to give share in profits of interim period to Jacob, and it was created with rupees 500 for interest on drawings. Right, I repeat, P&L suspense account was debited with rupees 1,10,000 for share in interim profits of Jacob, and P&L suspense account was credited with rupees 500 for interest on drawings of Jacob. It means the net debit balance in P&L suspense account is 1,10,000 minus 500, that is 1,09,500, and that will appear in the balance sheet. So now total of balance sheet liability side is 7,59,000. Sorry, 759,500, and here it would be 7,59,500. So this is how balance sheet of the firm would be as on 30th June 2023, immediately after Jacob's death. Here the alternate question given is again of a partnership firm where there are three partners, Kamal, Ali and John. Now later on 30th June 2023, Kamal has retired, and that time his capital account had balance of rupees 40,000 after all adjustments. The partners decided that Kamal to be paid rupee 50% of the amount due to him immediately, and the balance along with interest at 6% per annum be paid on 30th June 2024. The accounting year for the firm is April to March. We have to prepare here Kamal's loan account until it is finally closed. So at the time of Kamal's retirement, he was paid only 50%. That is 50% of 40,000 means 20,000 rupees, and remaining 20,000 which remained unpaid was transferred to his loan account on the date of his retirement. So we have to prepare Kamal's loan account. So on 30th June 2023, when he retired, that day his capital balance, sorry, his loan account balance was 20,000. And this balance has been paid to him on 30th June 2024, along with interest at the rate of 6% per annum. After the date of or after Kamal's retirement, the year ends on 31st March 2024. So we'll first close the year, and to before closing it, we will charge interest for the 9 months of this counting year 23-24, where the entry would be interest account debit to Kamal's loan account, and interest amount would be on 20,000 at the rate of 6% for 9 months, that is from 30th June 2023 till 31st March 2024, and that would be 20,000 into 6% means 1200 into 9 by 12, that is rupees 900. So on 31st March 2024, the balance in Kamal's account would be 20,900, and this is how the account would be closed for this year. We will reopen this account in the next accounting year on 1st April 2024 with 2,900. I'm sorry guys, here it would not be by balance brought down, but it would be by Kamal's capital account, because this 20,000 is getting transferred from his capital account to his loan account. The journal entry for that is Kamal's capital account debit to Kamal's loan account. Okay, so now here we have to make the payment on 30th June 2024. So here again we have to charge interest for 3 months, that is from 1st April 2024 till 30th June 2024. The journal entry for that would be interest account debit to Kamal's loan account on loan of rupees 20,000 at the rate of 6% per annum for 3 months. That is 20,000 into 6% means 1,200, and into 3 by 12, that is rupees 300. So the net amount payable to Kamal is rupees 21,200, which we have paid by debiting Kamal's account with rupees 21,200. So this is how Kamal's account would be made. Now, guys, here a question may arise. Somebody may ask that why I have not calculated this interest of 3 months on 30th June 2024 on the opening balance of rupees 20,900. The answer to that is the interest is charged not at compounding rate but at a simple interest rate. And since in the question also there is no mention whether interest should be charged at a simple interest or at a compounding rate, and that is why I have calculated this 300 on the principal outstanding amount of rupees 20,000 only. So let's move on. The question number 3 is about a company which has issued 50,000 6% debentures of rupees 100 each to the public at a discount of 5%, and these are redeemable after 3 years at a premium of 7%. Now on this date, the company also issued 1 lakh equity shares of rupees 10 each at a premium of rupees 2 per share. Both the issues were fully subscribed. We have to prepare the following accounts, that is 6% debentures account for the year 22-23 and loss on issue of debentures account. Now let's first talk about 6% debentures account. The debentures account at the time of issue of debentures, when debentures are issued in lump sum, comes in the second entry, that is 6% debenture application allotment account debit to 6% debentures account. However, since here we have discount also on issue of debentures, that is why the entry would be 6% debenture application allotment account debit with rupees 50,000 into 95. Then we will debit discount on issue of debentures account with the 5% of 100, that is rupees 5 into 50,000, that is 2,50,000 to 6% debentures account with rupees 50 lakhs. So on the credit side of 6% debentures account, we will write buy 6% debenture application allotment account with rupees 47 lakh 50,000. We will also write on the credit side of 6% debentures account buy discount on issue of debentures account with rupees 2 lakh 50,000. This is how the credit balance in 6% debentures account as at 31st March 2023 would be 50 lakhs. So I'm making that account first. So on 1st April 2022, we will have here buy 6% debenture application and allotment account with rupees 40 lakh 47 lakh 50,000, and by discount on issue of debentures account with rupees 2 lakh 50,000, and on 31st March 2023 will write to balance carried down with rupees 50 lakhs. And this is how the total here would be 50 lakhs. This is how 6% debentures account would be made, which will have credit balance of rupees 50 lakhs at its face value. Now, the other account that we have to make is loss on issue of debentures account. Since debentures are redeemable at a premium of 7%, that is rupees 7 per debenture. So on 50,000 debentures, the loss is 50,000 to 7, that is 3,50,000 rupees. That loss is also booked. That loss is also recorded at the time of issue of debentures only. The loss is a future loss, but still it is recorded because of the accounting concept of prudence or conservatism. So on 1st April 2022, the entry that would have been passed for loss on issue of debentures is loss on issue of debentures account debit to premium on redemption of debentures account. So here the entry would be posted in loss on issue of debentures account where we'll write to premium on redemption of debentures account with rupees 3,50,000, that is 50,000 debentures at the rate of rupees 7 per debenture, which is loss per debenture. Now, here in the same accounting year 22-23, the company has issued 1 lakh equity shares of rupees 10 each at a premium of rupees 2 per share. It means the company has collected securities premium of rupees 2 lakhs, 1 lakh into 2, that is rupees 2 lakhs. We know that this loss on issue of debentures is a capital loss and that should be written off in the same year in which it arises in books of a company. So to write it off, we can utilize the securities premium of rupees 2 lakhs. Since the loss amount is rupees 3,50,000, that is why the remaining loss of rupees 1,50,000 would be written off by using statement of P&L. So at the end of the accounting year, we will pass an accounting entry that is securities premium account debit, statement of P&L account debit to loss on issue of debentures account to write off this loss. So on the credit side of loss on issue of debentures account on 31st March 2023, we will write by securities premium account with rupees 2 lakhs and by statement of profit and loss account with remaining rupees 1 lakh 50,000. This is how the loss account will get closed with no balance in it. So this is how loss on issue of debentures account would be made. Now, next question, question number 4. This question is again of a company which on 1st April 2022 has following balances in 9% debentures There is a credit balance of rupees 50 lakhs. It means these are the outstanding debentures as on 1st April 2022 of Alpha Private Limited. And these debentures are redeemable on 31st March 2023, that is by the end of this accounting year 22-23, at a premium of 2%. And DRR has balance of rupees 5 lakhs. We know that a company, whether it is listed or unlisted, should have DRI, should make DRI. Now, Alpha Private Limited is a private limited company. A private limited company cannot be a listed company. It means Alpha Private Limited is not a listed company. Listed companies do not require to make DRR for redemption of its debentures, but Alpha Private Limited is not a listed company, and therefore it is also not an NBFC or housing finance company, so it needs to make DRR, and that is what it has done. A question also says that DRI, that is debenture redemption investment, which was purchased by the company on 1st April 2022, was realized at 101% on the date of redemption, and the debentures were redeemed on the due date. Now, what we have to do here is we have to prepare the following accounts, that is debenture holders account and debenture redemption investment account for the accounting year 22-23. Let's make debenture holders account. That is 9% debenture holders account. The debenture holders account would be created first for interest on debentures at the rate of 9% for the entire year. Why? Because debentures were issued. Okay, sorry, debentures had balance of rupees 50 lakhs on 1st April 2022, and they are redeemable on 31st March 2023. So for the entire year of 22-23, they are entitled to interest at the rate of 9% per annum. So the first entry that will pass in debenture holders account would be on 31st March 2023, where we will credit interest account. Means interest account would be debited and 9% debenture holders account would be created. With 9% of 50 lakhs, that is 4,50,000 rupees. Now on 31st March 2023, we have to redeem these debentures at a premium of 2%. So for that, the entry would be 9% debentures account debit with rupees 50 lakhs. Premium on redemption of debentures account debit with 2% of 50 lakhs, that is rupees 1 lakh, to 9% debenture holders account. So on the credit side of 9% debenture holders account, we will write by 9% debentures account with rupees 50 lakhs, and again by premium on redemption of debentures account with rupees 1 lakh. And then on this date, we will make payment to debenture holders of rupees 55 lakh 50,000. And this is how this account will get closed. So this is how our 9% debenture holders account would be. Now after this, we have to prepare debenture redemption investment account. The investments were made by the company as per the rules of or the provisions of the Companies Act 2013 on 30th April 2022. So on 30th April 2022, we will write here to bank. The investments were made at the rate of 15% as per the rules of the Companies Act 2013 of the outstanding debentures, sorry, of the face value of those debentures which are redeemable in that particular accounting year. So the debentures, the face value of the debentures which are redeemable in the accounting year 22-23 are rupees 50 lakhs. So 15% of that is 7 lakh 50,000, and that would be the amount of investment that the company needs to make by 30th April 2022. Okay, but the question says that the company has purchased investments on 1st April 2022, where I changed the date, and these investments were realized by the company on the date of redemption, that is on 31st March 2023, at 101%. It means against 7 lakh 50,000, the company has received 7 lakh 50 plus 7,500, that is 7 lakh 57,500. So that extra 1% received or realized by the company as its profit, which will go to its statement of P&L account. So here we will write by bank account with the total amount realized, that is 7 lakh 57,500. And on the debit side, on 31st March 2023, we'll write to statement of profit and loss account with the amount of profit 1% of 7 lakh 50,000, that is 7,500. This is how our debenture redemption investment account would be. So we are done with this question as well. And the next question that we have is, which is an alternate question. On 1st April 2022, Resorts Limited, a listed construction company, had 60,000 5% debentures of rupees 100 each, which are due for redemption at par on 31st March 2023. As per the law, investment was made in a fixed deposit of a bank on 30th April 2022, where the fixed deposit has interest at the rate of 5% per annum. Tax is deducted by the bank on interest at the rate of 10%. We have to pass journal entries in the year of redemption, including entries for interest on debenture redemption investment. And here we have to ignore the entries for interest on debentures. So for the accounting year 2022-23, we have to pass journal entries, and that should not include entries for interest on debentures. It means we have to pass entry for purchase of investment, that is making fixed deposit with the bank on 30th April 2022, and this fixed deposit would be withdrawn on the date of redemption, that is on 31st March 2023. So for that also we have to pass one entry. So first entry will pass on 30th April 2022, and we will debit debenture redemption investment account with the 15% of face value of those debentures which are redeemable in the accounting year 22-23, and that is 60,000 into 100, that is rupees 60 lakhs. So 15% of 60 lakhs is 9 lakhs to bank account, and this is how we have made fixed deposit of rupees 9 lakhs. The next entry would be on the date of redemption, that is on 31st March 2023. We will first withdraw fixed deposit, and for that we will debit bank account. We will also debit income tax, that is tax collected at source account, or income tax receivable account for the tax deducted by the bank on interest. We will credit debenture redemption investment account for withdrawal of investment of rupees 9 lakh, and we will credit interest on DRI account, that is on fixed deposit, and that interest is 5% of 9 lakhs, that is 45,000. This is for the entire year, but we will get interest only for 11 months, that is from 30th April 2022 till 31st March 2023. So on 9 lakhs at the rate of 5% for 11 months, that is 45,000 to 11 by 12. So 45,000 divided by 3 is 15,000. 15,000 divided by 4 is 3,750. So 3,750 into 11 is 3,011. 3,000 into 11 is 33,000 plus 750 into 11. So 700 into 11 is 7,700 plus 15 to 11 is 550. It means total interest is 41,250. If I'm not wrong, yeah, it would be 41,000, 33, 740, 40,700, 41,250. Right. Now on this, the bank has deducted tax at the rate of 10%. That is, tax amount is 4125. 10% of 41,250. It means the amount collected by the company from the bank against the fixed deposit is 9,41,250 minus 4125. That is 9,37,125. So this is how we will have the entry for liquidation of fixed deposit. Now we will redeem debentures. So for that, the entry would be 5% debentures account debit, rupees 60 lakhs, that is 60,000 debentures of rupees 100 each, to 5% debenture holders account with 60 lakhs, and then 5% debenture holders account debit with rupees 60 lakhs to bank account. So these are the four journal entries that we have to pass in this question. One entry for making investment in fixed deposit on 30th April at the rate of 15% of face value of debentures which are redeemable in the accounting year 22-23, that is rupees 9 lakhs. The other entry that I have passed is for liquidation or withdrawal of fixed deposit, where we have the company has earned interest of 41,250 on which the bank has deducted tax at the rate of 4125. The next entry is to transfer the claim of debentures to debenture holders account, and the last entry is for payment of claim to debenture holders account. So we are done with this question as well. Now the next question, question number 5. Here Anish has started a business with capital of rupees 3 lakhs on 1st April 2020. During the 3 years ending 31st March 2020, the results of the business were, so we have been given profit or loss of the company for these 3 years. Then from the year 2021 to 2023, Anish withdrew rupees 30,000 from the firm for his personal use. Okay. On 1st April 2023, he admitted Danish into partnership Danish into partnership on the following terms. Goodwill of the firm to be valued at 2 years purchase of the average profit of the last 3 years. Okay. So we have to give the formula to calculate goodwill by the average profit method. Danish to have 1/4 share in profits. We also have to value goodwill of the firm, and we have to calculate Danish's capital contribution. Danish Danish's capital to be equal to 1/4 of Anish's capital determined on 1st April 2023 after the goodwill composition has been taken into account. Okay. So first we give the formula to calculate goodwill with the average profit method. So goodwill is average profits multiplied with number of years of purchase of average profits, and before that we calculate average profits as sum total of normal operating profits of certain previous years divided by number of previous years considered for goodwill valuation. So this is how we first calculate average profits, for which we take normal operating profits of certain previous years. The sum total of these normal operating profits is then divided by number of previous years. Once we get the average profits, then we multiply this with number of years of purchase of average profits, and this is how we get goodwill. Now we also have to value self-generated goodwill of the firm, for which here we have been given profits and losses of past 3 years from 2021 to 22-23. The question says, A point of question says that goodwill is to be valued at 2 years purchase of average profit of the last 3 years. And Anish has withdrawn 30,000 from the firm for his personal use. That has nothing to do with the goodwill valuation. Okay, so let's calculate goodwill first. So here average profits would be minus 20,000 because the business of Anish had loss of rupees 20,000 in the year 2021. Then profits of 24,000, sorry, 34,000, then again profits of 46,000 divided by 3. That is 80 minus 20, 60 divided by 3 means 20,000. So this is how we have got value of goodwill as rupees 20,000. Sorry, value of average profits as rupees 20,000. Goodwill is average profits into number of years of purchase of average profits. So average profits are 20,000 and number of years are 2 years. It means value of goodwill is 40,000. Since Danish is being given 1/4 share in future profits, so Danish share in goodwill of the firm is 40,000 into 1 by 4, that is rupees 10,000, which he has to compensate to Anish. And for that, Anish's capital account would be created with rupees 10,000. So this is how Danish will compensate rupees 10,000 to Anish. Now we have to also find out the Danish's capital contribution. For this, the question says that Danish, the C point says that Danish's capital to be equal to 1/4 of Anish's capital determined on 1st April 2023 after the goodwill compensation has been taken into account. This 10,000 rupees will get added to Anish's capital. His capital at the beginning of or on 1st April 2020 was 3 lakh rupees. In the 3 years from 2021 to 22-23, his total profit or loss was 60,000, which we have already calculated here. So 3 lakhs plus 60,000. So his capital became 368 and he has withdrawn from 2021 to 22-23 rupees 30,000. So 360 minus 30 is 330. And later this 10,000 got added to his capital. So now Anish's capital balance is 340. So Anish's capital balance on 1st April 2023 when Danish joined is 3 lakhs plus collective amount of profits of 3 years 60,000 minus 30,000, that is the amount of drawings made by Anish, plus compensation for goodwill by Danish to Anish 10,000. That is 330 plus 10, 3 lakh 40,000. And the question says that Danish capital would be 1/4 of Anish's capital. So Danish's capital contribution would be 340 into 1 by 4, that is 85,000. Got this? So I hope you have understood this. We are done with this question as well. Now the next question, question number 6. Here we have been given balances of Medov Limited as at 31st March 2023. So we have capital reserve, plant and machinery, land and building statement of P&L, which has debit balance. Plant and machinery was given at cost. Short-term loans and advances, cash and bank balances, trade payables, accumulated depreciation on plant and machinery, bank overdraft, bills receivable, patents, sundry debtors, provision for doubtful debts, inventories, share capital, 5% debentures, one-fifth of which are redeemable on 31st March 2024, and these balances are of 31st March 2023. We have also been given additional information. The company had issued certain equity shares of rupees 10 each, which all applied for and allotted to the public. The shares were fully called up by the company. There was call scenarios at rupees 2 per share on 15,000 shares, out of which 5,000 shares were forfeited by the company. We have to prepare notes to accounts of share capital. We also have to give amount, means calculate amount of short-term borrowings, current assets, property, plant and equipment, and tangible assets. That is property, plant and equipment. That would be presented in balance sheet of the company. Okay, so let's see the balances given to us again on 31st March 2023. So we have to make notes to accounts for the year 22-23 only, means as at 31st March 2023 only. And from the ledger extracts, we have share capital of rupees 12 lakh 20,000. We do not have any other item here in this table related to share capital. So share capital is already 12 lakh 20,000. And here company has further issued shares of, okay, no, it is the additional information given to us. So total share capital of the company is 12 lakh 50,000 rupees. That is 1 lakh 25,000 into 10. On 15,000 shares, the company has not received rupees 2 per share. So 1250 minus 30,000 is 1220, and that is what is reflected in its ledger, 1220. Now, out of these 15,000 shares, the company has forfeited 5,000 shares. So let's make notes to accounts of share capital first. You know that note for share capital is note number one, the very first item of the balance sheet. Here we write authorized capital first. We do not know the number of shares as its authorized capital, but we know that each share is of rupees 10. Issued capital is 1,25,000 equity shares of rupees 10 each, that is 12,50,000. In calls in areas there were 30,000 rupees, but since and these were of 15,000 shares, but since 5,000 shares have been forfeited by the company, now there would be calls in areas of 10,000 shares only at the rate of 2, that is rupees 20,000. Okay, so issued capital I'm showing here 12,50,000. Subscribe the capital, subscribed and fully paid. We do not have any subscribed and fully paid. Why? Because we still have 10,000 shares which have not been forfeited, on which there is unpaid calls of rupees 2 per share. So you'll have only subscribed but not fully paid. And here we will show 1,20,000 shares because 5,000 shares have been forfeited. So 1,20,000 equity shares of rupees 10 each, that is 12 lakhs, less calls and arrears on 10,000 shares at the rate of rupees 2 per share. These are those 10,000 shares which have not been forfeited yet. So here the amount is 11,80,000, and to this we will add forfeited shares amount on the shares which have been forfeited. So on the forfeited shares of 5,000 we have not received rupees 2 per share, but we have received rupees 8 per share, and that 8 per share has gone to share forfeiture account. So 5,000 into 8, that is 40,000 rupees, is share forfeiture balance, balance of share forfeiture account. It means the capital, net capital amount, the paid up capital is 12,20,000. And that is what was reflecting in its ledger. the ledger extract. That is here 12 lakh 20,000. So with this, we have made notes to accounts of share capital. Now we have to give the amount of short-term borrowings. So short-term borrowings items are bank overdraft, and one-fifth of debentures because they are redeemable within 1 year from the date of these balances, that is on 31st March 2023. So one-fifth of 3 lakhs is 60,000. I'm considering this short-term loans and advances as assets, and that is why I'm not considering this in short-term borrowing. So short-term borrowings amount is 40,000 of bank overdraft and one-fifth of 3 lakhs, that is 60,000. It means the amount of short-term borrowings is 40 plus 60 means 1 lakh. Now, current assets. In current assets, we have short-term loans and advances of rupees 50,000. We have bills receivable of 20,000. We have debtors of 90,000, inventories of 30,000. So total of current assets are 50,000 plus 20 bills receivable 70, 70 plus 90, that is 160, and 160 plus 30, that is 190. So 190 is the amount of current assets. If we have to take current assets net of PFDD, then 190 minus 10, 180 would be the amount of current assets. Now, property, plant, and equipment, that also we have to show the amount of that. So here we have been given plant and machinery at cost of 6 lakhs, land and building of 680, accumulated depreciation on plant and machinery is 1 lakh. So 6 lakhs of plant and machinery minus 1 lakh, its accumulated depreciation, that is 5 lakh. 5 lakh plus 680, that is 11 lakh 80,000. That's it. So 11 lakh 80,000 would be the amount of property, plant, and equipment. Now, next question. Question number 7. So here we have two partners, Amma and Sujoy. They are sharing profits and losses in 3:1 and their balance sheet on 31st March 2023 is given. On 1st April 2023, they have admitted Malay as a new partner for 1/4 share in profits of the firm with the following terms. Malay to bring his share of capital of rupees 120 and to pay rupees 10,000 cash for his share of goodwill. Since his profit share is 1/4, it means goodwill of the firm is 10,000 into reciprocal of 1/4, that is 4 by 1, means 40,000. Now stock worth 45,000 to be taken over by Amay at rupees 25,000. Bills payable of 20,000 to be honored by Sujoy, for which he is not to be reimbursed, and capitals of Amay and Sujoy to be adjusted on the basis of Malay's capital and his share in profits, means on the basis of new profit sharing ratio, and any surplus to be adjusted through current account and deficiency through cash. Means if there is any surplus in capital, that would be adjusted with current account. If there is any deficiency in capital, that for that partner has to bring cash. We have to prepare partners capital accounts only here. So let's do this. I'm making some working notes here. First of all, I'm calculating new share of Uma and Sujoy after Malay's admission. Now, Amar and Sujoy earlier were sharing profits and losses in 3:1, and Malay, the new partner, has been given profit share of 1/4. How he has been given 1/4, that is not given to us in the question. It means we'll assume that Malay was given 1/4 by Amar and Sujoy in their old ratio 3:1. So it means Amar's new share is 3 by 4, which was his old share, minus 3 by 4 of 1 by 4. It means this much Amay has given, that is 3/4 of 1 by 4 to Malay. So it is 3 by 4 minus 3 by 16, that is 12 minus 3, means 9 by 16 is Amay's new share. So Joy's new share would be calculated in the same way. Earlier Sujoy was getting 1 by 4. Now he has given 1 by 4 of 1 by 4 to Malay. So 3 by 16 is Sujoy's new share. It means sacrificing ratio of Amay and Sujoy is their old ratio, that is 3 by 16 is to 1 by 16, that is 3 is to 1. Now why I've calculated this is to compensate the sacrificing partners Amay and Sujoy for share and goodwill that would be enjoyed by Malay, for which he has brought rupees 10,000 in cash. Now here we have been given 2 points, point number B and C, which relates to revaluation. The point number B says that stock worth rupees 45,000 to be taken over by Amay at rupees 25,000. It means the value of a stock having book value of 45,000 is 25,000. It means the stock has to be reduced by 20,000 first. So revaluation profit or loss I'm calculating here in working notes. We have loss of 20,000 in a stock because of point number B. Since it is loss, I have taken this in brackets. And bills payable rupees 20,000 to be honored by Sujoy, for which he is not to be reimbursed. It means Sujoy will take care of bills payable of 20,000, and the firm does not need to pay to Sujoy for that bills payable. So this is how firm has profit of 20,000, and because of this there is no profit or loss upon revaluation of assets and reassessment of liabilities. Right? Now we make partners capital accounts. We have Amay, Sujoy, and Malay. Capital balances of Amay and Sujoy as given in their balance sheet were 1,30,000 and 1,25,000 respectively. Now Malay has brought rupees 1,20,000 for his capital, and rupees 10,000 cash for his share in goodwill of the firm, which will go to the sacrificing partners. So the 10,000 of premium for goodwill will go to sacrificing partners. Amma and Sujo in their sacrificing ratio 3 is to 1. That is 7,500 will go to Amma and 2,500 will go to Sujoy. Since Amma has taken over a stock of rupees 25,000, stock at rupees 25,000, his capital would be debited with 25,000. Now, after this, the capital balances of the three partners we need to calculate first. There is 1,37,500. There is 1,27,500. Here we have 120. So Amay's capital balance is 1,12,500. Sujoy's is 1,27,500. And Malay's is 1,20,000. Now the D point says that capitals of Ajay and Amay and Sujoy would be adjusted on the basis of Malay's capital and his share in profits. So for one fourth share, Malay's capital is 1,20,000. So for 9 by 16 share, that is this one, Amay's capital should be 1,20,000 into reciprocal of 1 by 4, that is 4 by 1 into 9 by 16, that is 4 means 30 means 2,70,000. So Amay's capital should be 270 and so Joe's capital for 3 by 16 share, Joe's capital should be 1,20,000 into reciprocal of 1 by 4, that is 4 by 1 into 3 by 16, that is 30 into 390,000. So Amay's capital balance should be 270, but his capital balance is 1,37,500. So he has deficiency in his capital, and for that he will bring cash. And Sujoy's capital should be 90,000, but his capital balance is 1,27,500. So for the surplus capital, his current account would be adjusted. So he'll reopen partners capital accounts, and Amay will bring the deficiency, that is 2,70,000 minus 1,37,500, that is 1,32,500. And Sujay's capital would be reduced by transferring the surplus capital to his current account. And that is 1,27,500 minus 90,000, that is 37,500. So this is how now the new capital balances of the three partners would be 2,70,000, 90,000, and 1,20,000. I hope you have got this. So now move to the next question. So this question is again of partnership where there are two partners, Mitu and Situ, and they are Mitu and Ritu, I'm sorry, and they are sharing profits and losses in the ratio of 2 is to 3. Their balance sheet as at 31st March 2023 is given to us. We have WCR here, General Reserve, Investment Fluctuation Reserve, then investments, sundry debtors, and P&L account balance, debit balance. Now, on 1st April 2023, they have admitted Neetu as a new partner for 1/5 share in profits on the following terms regarding the treatment of reserves and accumulated losses. Accumulated losses, if any, to be written off. Now, there is workman compensation claim of rupees 10,000 to be adjusted against the workman compensation reserve. This is what exactly we do. The balance of the reserve is not to be distributed. Okay. And claim is 10,000 and WCR is 30,000. It means after adjusting the claim, after adjusting WCR for the claim, the remaining balance in WCR would be rupees 20,000 and that has not to be distributed. Any loss in the value of investments to be adjusted against the investment fluctuation reserve. Okay, this is what exactly we do normally. And the balance of IFR is to be distributed. Okay, and then provision for doubtful debts is to be created to the extent of 10% of the debtors from the general reserve. And the remaining amount of general reserve is to be distributed. So out of the three reserves, we do not have to distribute workman compensation reserve and we have to distribute IFR and general reserve. We have to pass necessary journal entries to record the above adjustments at the time of Neetu's admission. So here, what is not given is and what is not required is goodwill valuation of the firm. on admission of Neetu. We just have to pass journal entries for the above adjustments. How much capital Neetu is bringing, that is also not given to us, because this is, and even we do not know capitals of Meetu and Ritu, because this is not a full-fledged balance sheet but extract of the balance sheet only, which focuses on treatment of reserves only. So we will pass here one entry for writing off accumulated losses, that is debit balance of P&L of rupees 55,000. We will pass one entry to create liability for workman compensation claim out of the reserves. The third entry will pass for reserves which are not to be distributed, that is WCR. The fourth entry will pass for distribution of IFR, and the fifth entry will pass for distribution of general reserve. We can pass a joint entry for distribution of IFR as well as general reserve, and then the last entry will pass for transfer of certain amount from general reserve to PFTT. So let's pass the journal entries for this question. The first journal entry would be for distribution of, for writing off accumulated losses, and the losses are of rupees 55,000, and profit sharing ratio of Meetu and Ritu, that is old partners, is 2 is to 3. So 22,000 will go to Meetu, and 33,000 will go to Ritu. So the entry here would be Meetu's capital account debit with 22,000, and Ritu's capital account debit with 33,000 to profit and loss account with 55,000. This is our first entry. Second entry would be for making liability for workman compensation claim, for which we will debit workman compensation reserve account with the amount of claim, and then we'll credit to liability for workman compensation with 10,000. The third entry will pass for adjusting loss. Okay, before that, we will pass the entry for the balance of WCR. So after adjusting the claim, after making the liability for workman compensation out of workman compensation reserve of rupees 10,000, the balance in WCR is 20,000. Since it has not to be distributed, for that the old partners would be compensated. After Neetu's admission, what would be the new profit sharing ratio? That is not given to us. So in that case, we will assume that Neetu would be given 1 by 5 share by Meetu and Ritu in their old ratio 2 is to 3. And in that case, sacrificing ratio of Meetu and Ritu would be 2 is to 3 only. So our next entry would be Neetu's capital account debit with 1/5 of 30,000, sorry, 20,000. That is rupees 4,000. And this will go to Mitu and Ritu in their sacrificing ratio 2 is to 3. That is 1,600 and 2,400. This is the journal entry would be for the WCR balance, which is not to be distributed. Now, next entry would be for loss in the value of investments. Book value of investments is 80,000, whereas its market value is 76,000. It means there is a loss of 4,000, and that loss would be adjusted with IFR. For that, the journal entry would be IFR account debit to investments account with rupees 4,000. That is 80 minus 76,000. The next entry would be for distribution of IFR. The balance of IFR now, after debiting IFR with 4,000, is 6,000. But before we distribute IFR, let's make PFDD to the extent of 10% of datas from general reserve. So datas value given to us in balance sheet is 1 lakh. 10% of that is 10,000. So from general reserve, we will transfer 10,000 to PFDD account. And the journal entry for that would be general reserve account debit to provision for doubtful debts account with rupees 10,000. That is 10% of 1 lakh. So after doing this, now the balance in general reserve is 30,000. So we have 30,000 credit balance in general reserve and 6,000 credit balance in IFR account, and both these are to be distributed among the old partners in their old ratio. And for that, the last entry would be investment fluctuation reserve account debit general reserve account debit to Me Too's capital account. to Ritu's capital account. The balance in general reserve account is 6,000 because out of 10, 4,000 has been used to decrease the value of investments, and the balance in general reserve is 20,000 because out of reserves of 30,000, 10,000 has been transferred to PFDD account here. So total 30 minus, sorry, it is 30,000, not 20. That is 40 minus 10. So now total amount of 36,000 is to be distributed among the old partners, Mitu and Ritu, in their old profit sharing ratio 2 is to 3. So 36,000 into 2 by 5, that is 28,800. I'm sorry, it is 14,400. And 36,000 into 3 by 5, that is 21,600, will go to Ritu. So this is how we are done with all the journal entries. I'm sorry, students, I'm not writing the narration. I hope you at least understand that much and can write the narration yourself. So this is how for this question we will have 6 entries. One for writing of accumulated loss, that is debit balance of P&L among the old partners in their old ratio 2 is to 3. The next one I did is to make liability for workman compensation out of WCR. After that, the remaining amount of WCR which is not to be distributed, for that we have passed this entry. And here Neetu is compensating the sacrificing partner Meetu and Ritu in their sacrificing ratio 2 is to 3. After that, the next entry was to record the loss in the value of investments because of unfavorable change in its market value. For that, we used investment fluctuation reserve. After that, we transferred from general reserve to PFDD account. And after that, the remaining balance of IFR and general reserve we distributed among the old partners in their old ratio 2 is to 3. So we are done with this question as well. Now, the next question. So in this question, we have again, it is again of partnership where there are two partners other than Shiv. They are sharing profits and losses in the ratio of 5 is to 4. They dissolved their partnership firm on 31st March 2023, and their balance sheet showed the following balances. We have been given balances of Adit's capital, Shiv's capital, Adit's current account, Shiv's current account, loan by the firm to Shiv. So here, firm has given loan to Shiv, and then debit balance in P&L account of rupees 4,500. On the date of dissolution of the firm suffered a loss of rupees 18,000 upon realization of assets and settlement of liabilities. So the net profit or loss upon realization is already given to us, which is rupees 18,000. Expenses of dissolution were rupees 3,000, which were to be borne by Shiv. However, these expenses were paid by the firm on behalf of Shiv. The firm had furniture of rupees 15,000, and Adit took over some pieces of the furniture at 9,000 rupees, which is 10% less than the book value of the furniture taken over by Adit. Shiv took over the remaining furniture at at 80% of its book value. So we have to find the value of furniture taken over by Adit and Shiv, and then we have to prepare partners' capital accounts. Okay, so let's start with this question. Total value of furniture. The book value of furniture was rupees 15,000. Other took over some pieces of the furniture at rupees 9,000. That is being 10% less than the book value. It means book value of the furniture taken over by Adit is 9,000, which is equivalent to 90% of the book value, because Adit has taken some furniture at 10% less than its book value. 10% less of anything is equivalent to 90%. It means this 9,000 equivalent to 90%. So 100% would be 10,000. Now, why we have calculated this? We have calculated this amount so that we could know the value of furniture at which Shiv took it over. And Shiv has taken the remaining furniture at 80% of its book value. So book value of furniture taken over by Shiv is 15,000 minus 10,000, because total furniture were of 15. Out of that, furniture having book value of 10,000 were taken over by Adit. So value at which Shiv took over the furniture of rupees 5,000 is 80% of 5,000, that is 4,000. So to calculate this amount, we did all these calculations. I hope you have understood this. Now I'm making partners' capital accounts. We have Adit and we have Shiv. Their capital balances given to us are 40,000, 30,000 respectively. Now, there was loss upon realization of assets and settlement of liabilities of rupees 18,000. So 18,000 will go to the debit side of Adit and Shiv's capital accounts in their ratio 5:4. That is 10,000 and 8,000. So 18,000 loss of realization I have distributed, or I have divided among the partners in their old ratio, in their ratio, given ratio 5:4. Now I'm transferring their current account balances. So Adit has credit balance of rupees 3000 in his current account. So current account would be debited and his capital account would be credited with rupees 3000. And Shiv has debit balance in his current account of rupees 6000. So current account of Shiv would be credited and his capital account would be debited. For that, we'll write here Shiv's current account with rupees 6000. Besides, Shiv has also taken loan of rupees 22,000 from the firm. It means Shiv's loan account has debit balance of 22,000, so that also would be transferred to his capital account. 22,000. The dissolution expenses of 3,000 are to be borne by Shiv, but were paid by the firm on his behalf. So for that, the entry would be Shiv's capital account debit to cash account. So on the debit side of Shiv's capital account, we will write to cash account of rupees 3000. P&L account has debit balance of 4500, so that has to be that has to be written off among the partners in their given ratio 5:4. That is 2500 and 2000. So the 4500 rupees loss I have written off by debiting Adit's and Shiv's capital account in their given ratio 5:4. Adit has taken furniture at a value of rupees 9,000. So for that we will debit Adit's capital account with 9,000. This is for furniture. And Shiv also has taken over furniture at a value of rupees 4,000. So that also I have recorded here by debiting their capital with rupees 9,000 and 4,000 respectively. So with this we have taken care of everything. Now let's see what is the balance in partners capital accounts. Shiv's capital account shows debit balance. This is 14, 22, 36, 39, 41 and 45,000 here total. And here the total is 43,000. It means Shiv has to bring deficiency in his capital account of rupees 15,000. That is 45 minus 30,000. For that, the entry would be cash account debit to Shiv's capital account 15,000 and Adit's has credit balance of 21,500. So that much of cash would be paid to Adit. This is how our capital account would be of the two partners, Adit and Shiv. So this question number 8 is also done. Now question number 9. So here also it's a question of partnership where there are two partners, Tanuj and Ravi, with capital balances of 1 lakh 50 and 1 lakh on 1st April 2022. As per their partnership deed, they are entitled to interest on capital at the rate of 10% per annum. They are to be charged interest on drawings at the rate of 4% per annum. And Tanuj is to be given commission at the rate of 5% of the trading profits. Trading profits means net profits after charging his commission. Okay. So 5% commission which is to be given to Tanuj is not on the net profits, but from net profit we have to subtract Tanuj's commission, and whatsoever is the derived amount of that, Tanuj should get 5% commission. Yeah. Then Ravi is entitled to annual commission of 10,000. Now we have been given some additional information that Tanuj withdrew rupees 6,000 at the end of every quarter. Trading profits are given, that is net profits are 84,000 rupees. Firm's divisible profits were 46,360. Divisible profits means out of the net profits of 84,000, the firm has made some reserves, and after that the divisible profits are 46,360. On 1st October 2022, Ravi permanently withdrew 20,000 from his capital. Ravi's capital at the beginning of the year was 1 lakh, and after that he withdrew rupees 20,000 from his capital. We have to pass journal entries to record permanent withdrawal by Ravi for distribution of divisible profits between the partners, adjusting entry for commission due to Ravi. We also have to calculate interest on capital of Ravi and Tanuj. We have to calculate commission to Tanuj, and we have to calculate interest on drawings charged from Tanuj. So there are many calculations in it. Let's start with that. Okay, what we have to do is we have to pass journal entries for permanent withdrawal made by Ravi. We also have to calculate interest on capital of Tanuj and Ravi. Have to calculate commission and have to calculate interest on drawings of Tanuj. So let's start with calculation of interest on capital. Interest on capital payable to Tanuj. His capital at the beginning of the year was rupees 1,50,000. Given to us here. So on 150 at the rate of 10% per annum, the interest on capital of Tanuj is 15,000. The interest on payable to Ravi Ravi's initial capital was 1 lakh, but later he withdrew on 1st October 2022 20,000. So for first 6 months, he would be given IOC at the rate of 10%, and later his capital became 80,000. Why? Because he permanently withdrew 20,000 from his capital. So for the remaining 6 months, we will calculate interest on capital of 80,000 rupees. So this is 10,000 and half of that is 5,000. This is 8,000 and half of that is 4,000. That is 9,000. So this is how we have calculated interest on capital of both Tanuj and Ravi. Now we have to calculate commission allowed to Tanuj. Tanuj is to be given commission rate of 5% of the net profit of a trading profit after charging his commission. And trading profits given to us are rupees 84,000. So Tanuj's commission would be 84,000 into 5 divided by 105. That is 84,000 divided by 21. That is 4,000. So we have calculated commission payable to Tanuj also. Now, interest on drawings charged from Tanuj. Tanuj has withdrawn rupees 6,000 at the end of every quarter, and rate of interest on drawings is 4% per annum. So he has withdrawn 6,000 4 times in a quarter, 4 times in a year, I'm sorry. The rate of interest on drawings is 4%, and average period here would be he has withdrawn at the end of every quarter. So the period of drawing of the first drawing would be 9 months, and of the last drawing 0 months. So 9 plus 0 divided by 2, that is 4.5 months would be average period. So this is 60 and 16 96. 960 divided by 12 is 80. 80 into 4 is 320, and half of 80 is 40. So interest here would be 360. So we have calculated interest on drawings for Tanuj also. Now we are left with only the first part of this question, that is to pass journal entries. So the entry for permanent withdrawal made by Ravi, Ravi's capital account debit to cash account. With rupees 20,000. I have taken here cash since we do not know how the drawings were made, whether in money form or by withdrawings anything other than money. The entry for distribution of the divisible profits between the partners. Now here we do not have profit sharing ratio of the partners. In that case, We'll assume that the profit and loss is to be distributed among the partners in in equal ratio. So let first calculate divisible profit. Trading profits are 84,000. Out of that, 4,000 is the commission payable to Tanuj. Then commission of 10,000 to Ravi. Then interest on capital of Tanuj is 15,000 and of Ravi it is 9,000. Okay, we have already been given divisible profits of the firm 46,360. So we do not need to calculate that. We just have to pass journal entry for its distribution. The journal entry for that would be profit and loss, appropriation account debit to Tanuj's capital account to Ravi's capital account. The amount of divisible profit is 46,360. So 23,180 will go to A, that is half of 46,360, and 23,180 will go to Ravi. 23,180 to Tanuj and 23,180 to Ravi. Now we have to pass adjusting entry for commission due to Ravi. Commission due to Ravi is 10,000, and for that the entry would be, we have to pass adjusting entry and not the closing entry, and therefore the entry would be commission account debit with 10,000 to Ravi's capital account with 10,000. This is how we have passed all the three journal entries which were asked to us. We have also calculated interest on capital of Tanuj and Ravi, that is 15,000 and 9,000 respectively. We have also calculated commission to Tanuj 4,000 and interest on drawings of Tanuj 360. So this is how this question is also done. The next question is of two partners, Amit and Iqbal, and as per their partnership deed, IOD is to be charged at the rate of 6% per annum. Amit is entitled to a salary of rupees 1,000 per month. Iqbal is entitled to annual commission of rupees 10,000. And any partner taking a loan from the firm to be charged interest on it at the rate of 8% per annum. Now we have been given some additional information also. Drawings made by Iqbal of rupees 30,000 on 1st May 2022. Amit has borrowed from the firm rupees 10,000 on 1st July 2022. Capital balance of the two partners on 31st March 2023 are 75,000 and 10,000 respectively, where 10,000 is the debit balance, that is negative balance of capital, and divisible profits credited to partners' capital accounts were 9,000, 9,000. Means the profits were distributed among the partners equally. We have to give closing entry for interest on loan due from Amit, and we have to find opening capital balance of the partners on 1st April 2022. Why? Because the capital balances given to us here are of 31st March 2023. And for that, we have to know opening capital balance. We have to prepare partners' capital accounts for the year 2022-23. So let's do this. First, we calculate interest on loan to be collected from Amit. Amit has borrowed from the firm rupees 10,000 on 1st July 2022. So interest on loan from Amit is on 10,000 at the rate of 8% per annum for 9 months. Why? Because he has borrowed on 1st July 2022. So from 1st July 2022 till 31st March 2023, that is for 9 months, we have to calculate interest on the amount borrowed by Amit from the firm. So this is 800 into 9 by 12, that is 800 into 3 by 4 means 600. Now the journal entry for this, the closing entry for interest on loan due from Amit, not the adjusting entry, but the closing entry we have been asked here. So the closing entry for that would be interest on loan account debit with rupees 600 to profit and loss account with rupees 600. This interest will go on the credit side of P&L account because this interest is an income for the business, and that is why it has been transferred to the credit side of P&L account. Now we have to find opening capital balance of the partners on 1st April 2022 by preparing partners' capital accounts. And we also need to calculate interest on drawings on the drawings made by Iqbal. So interest on drawings of Iqbal. Iqbal has withdrawn rupees 30,000 on 1st May 2022. So from 1st May 2022 till 31st March 2023, we have period of 11 months. So for 11 months, at the rate of 6% per annum, he would be charged interest on 30,000. So this would be 1800 into 11 by 12. That is 150 into 11. So it would be 1650. So now we have to make partners' capital accounts to find out opening capital balances. We do not know the opening capital, that is the capital as at 1st April 2022. This would be the balancing figure, which we will get to know at the end. Okay. So drawings made by Iqbal are 30,000. So that will come on the debit side. Then borrowing by Amit of rupees 10,000 from the firm. For this will not go to partner's capital account. Interest on drawings of Iqbal we have already calculated, and that is rupees 1,650. Then salary to Amit of rupees 1,000 per month. So for the entire year, it would be 12,000 rupees. That will go on the credit side. Then commission of rupees 10,000 to Iqbal, again on the credit side of partners capital account. Interest on loan to be recovered from Amit is rupees 600. So that will go on the debit side of partners capital account. Residual profit is rupees 9,000 for each of them. Again would be coming on the credit side. By profit and loss appropriation account. And the closing balance of capital, that is capital balance is as at 31st March 2023 are 75,000 for Amit, which is credit balance, and for Iqbal it is 10,000 debit balance. So this is how we have taken everything in our partners' capital accounts. So the total of credit side of Amit's capital is 75,600, and of Iqbal it is 31,650. So 75,600 minus 21,000 is 54,600. This is the opening capital balance of Amit, and Iqbal's opening capital balance is 31,650 minus 29,000, that is 2,650. So this is how we will have our capital accounts of the two partners, Amit and Iqbal. And we have got opening capitals of the two partners. So we are done with this question as well. Now, next question, question number 10. So it is of issue of shares where a company has issued 20,000 equity shares of rupees 10 each to the public. The money is payable as rupees 2 on application, 3 on allotment on 1st November 2022, and rupees 5 on first and final call on 1st March 2023. And this is how rupees 10 per share are to be collected by the company. Applications were received for 25,000 shares. It means there is oversubscription. The directors of the company have accepted applications for 20,000 shares and refunded the application money on the remaining shares. It means there is no pro rata allotment because the excess applications were rejected and the money for that were refunded. One shareholder who was allotted 30 shares paid the first and final call with allotment, and another shareholder did not pay his allotment on 20 shares when it became due but paid it later with the first and final call, along with interest on calls in arrears. The directors of the company charged interest on calls in arrears at the rate provided in Table F of the Companies Act 2013, which is 10% per annum, and no interest was allowed on calls in advance. We have to pass journal entries to record the above transactions in the books of Gamma Limited. It's a easy question. There is no forfeiture, there is no pro rata allotment, there is no oversubscription, no premium. Journal entries, the first entry would be for application money of rupees 2 per share on 25,000 shares. That is bank account debit to equity share application account with 50,000, that is for 25,000 at the rate of 2 per share. The second entry would be for transfer of application money to capital account. So equity share application account debit to equity share capital account with 50,000. Third entry would be for making allotment account due. So equity share allotment account debit Okay. I, I'm sorry. Here, company has allotted only 20,000 shares. Why? Because only 20,000 shares were issued and has refunded the application money on the remaining shares. So I need to pass the entry for that also. And in that case, here it would be 40,000. That is on 20,000 shares at the rate of rupees 2 per share. And for remaining 5,000 excess shares, application money would be refunded. So here we will have two bank account also with 10,000 for 5,000 shares at the rate of rupees 2 per share. Now equity share allotment account debit with 20,000 into 3 rupees of allotment, that is 60,000. And the company has passed this entry on 1st November 2022. So equity share allotment account debit to equity share capital account with 60,000. Then bank account debit. Now here a shareholder did not pay his allotment money on 20 shares, but later paid it with first and final call along with interest on calls in arrears. And another shareholder who was allotted 30 shares paid the first and final call money with allotment. First and final call money is rupees 5 per share. So on 30 shares, we have received 30 into 5, that is 150 rupees in advance. And on 20 shares, 20 into 3 of allotment, that is 60 rupees, we have not received. So here we will also debit calls in arrears account for 20 shares at the rate of rupees 3 per share, that is 60. We will credit equity share allotment account and will also credit calls in advance account for 30 shares at the rate of rupees 5 per share, that is rupees 150. Equity share allotment account would be created with the same amount with which it was debited here with rupees 60,000. That is 20,000 into 3. So company has to receive 60,000, but it has received 150 more. So 60,150 it should have received, but 60 rupees of allotment it has not received. So the net amount received by the company is 60,150 minus 60, that is 60,090. This is balancing figure. Now the next entry, to make first and final call money due, and for that equity share first and final call account would be debited with 20,000 into 5, that is 1 lakh rupees. To equity share capital account with rupees 1 lakh. And the sixth entry, which is for receipt of first and final call money, bank account debit to equity share first and final call account. The amount with which it was debited, with the same amount it would be created, that is with rupees 1 lakh for 20,000 shares at the rate of rupees 5 per share. But here company has also received the amount which it did not receive at the time of allotment, that is on 20 shares at the rate of rupees 3 per share, that has also been received. So we'll credit to call scenarios account with rupees 60. In this entry, we will also debit calls in advance account for the money not needed by the company. Why? Because it has already been received by the company in advance, that is rupees 150 on 30 shares at the rate of rupees 5. And our first and final call is getting due on 1st March 2023. So here the date would be 1st March 2023. Here company has also received interest on call scenarios, and the interest is on rupees 60, which should have been received on 1st November 2022 but were received on 1st March 2023, that is after 4 months: November, December, January, and February. So for 4 months on this rupees 60, the company has collected interest at the rate of 10% per annum as per the rules of the Companies Act. So 60 into 10% for 4 months, the interest amount would be rupees 2. It means the amount the company has received is 1,62,000 minus 150, that is 99,912 rupees. This is our balancing amount. So this is how we are done with all the journal entries. We can pass one more journal entry here for interest on for transfer of interest on calls and arrears to statement of P&L account. And for that, the entry would be interest on calls and arrears account debit with rupees 2 to statement of profit and loss account with rupees 2. This is how we have passed all the journal entries for this question, and our this question is also done. Now we have next question again of shares, where a company Roxy Limited has issued equity shares of rupees 10 each, where the money is payable as rupees 4 on application and allotment, rupees 2 on final first call, and rupees 4 on second and final call. And we have been given the extract of journal of Roxy Limited. Now we have to fill the Missing information represented by question mark. So the first information that we have to fill here is being first call due on. We have to calculate your number of shares. Since rupees 4 is application allotment money, okay, we have not been given journal entries right from the beginning, that is from application allotment. The first journal entry that is given to us is for first call. First call is rupees 2 per share. So for 28,000 rupees at the rate of rupees 2, the number of shares here would be 14,000. So the answer here is 14,000. That is 28,000 divided by 2. The next entry is of first call account only, the receipt entry of first call, where first call account has been created with 28,000. Call scenario is as 2,000. It means the bank account would be debited with 26,000. That is 28 minus 2,000. Being first call received on. So since first call money has been received and that money is 26,000 and first call amount is rupees 2 per share, it means on 13,000 shares the company has received first call money. So here it would be 13,000 shares. That is 26,000 divided by 2. So here the number of shares on which the company has received first call money is 13,000. Now the next entry is for forfeiture of shares. We have to find the amount of share capital and we also have to find the number of shares which have been forfeited. Now share forfeited account has been created with 4,000. It means this much money has been received. And since the shares have been forfeited for non-payment of first call, it means the money received here of 4,000 is application allotment money. And application allotment money was rupees 4 per share. It means this amount is for 1,000 shares. This 4,000 is coming for 1,000 shares. So here number of shares forfeited are 1,000. So share capital account would be debited with 1,000 into 4 of application and 2 of first call, that is rupees 6 per share. So on 1,000 shares at the rate of rupees 6, that is 6,000 would be the amount here. And here amount of call scenarios is 1000 into 2, that is rupees 2000. The next entry is of making second call money due. Now, first call was made due for 14,000 shares, out of which 1,000 shares have been forfeited here. It means on 13,000 shares only second and final call would be made at the rate of rupees 4 per share. So here it is 13,000 shares, that is 14,000 minus 1,000 which have been forfeited. And 13,000 into 4 rupees of second and final call is 52,000. So our number of shares that we have determined here is correct. Now the next entry here is of receipt of second and final call money, where there is call scenarios of 10,000. It means the money received on second and final call is 52 minus 10, that is 42,000. Second and final call money is rupees 4 per share. It means, and call scenario says here is 10,000. It means on 2,500 shares the company has not received second and final call money. Now next entry is again of forfeiture of shares, and this forfeiture has been done for non-payment of final call. It means those shareholders who have paid application allotment and first call money but not the final call, their shares have been forfeited. Call scenarios is 10,000. It means on 2,500 shares, final call money was not received. How I got 2,500 is 10,000 divided by 4. So here we will have 2,500. That is 10,000 divided by 4. So share capital account would be debited with 10,000, sorry, with 2,500 into 10, that is 25,000. And share forfeited account would be created with 2,500 into 6, that is 15,000, for the amount that the company has received on these 2,500 shares. So 2,500 into 6, rupees 6 is, so rupees 6 includes rupees 4 of allotment and application, and rupees 2 is of first call. So we are done with this entry also. Now the next entry is for reissue of forfeited shares. Here company has reissued 1,500 shares, and company has reissued them at rupees 6 per share, fully called up. And called up money is rupees 10 per share, that is 4 of application allotment, 2 of first call, and 4 of second and final call. It means share capital account would be created with 1500 into 6, sorry, 1500 into 10, I'm sorry, that is rupees 15,000. Whereas share forfeited account would be, and bank account would be debited with 1500 into 6, which has been received by the company, that is rupees 9,000. The discount given by the company here is rupees 4 per share. That would be debited to share forfeited account, 1500 into 4. That is rupees 6,000. So the shares which have been forfeited and reissued are those 1500 shares on which the first call was not received. First call was not received on 13,000, sorry, on 1,000 shares. So out of 14,000 shares, company received first call money on 13,000 shares. So here 1,000 shares are those on which first call money has not been received. So those 1,000 have been forfeited here. And remaining 500 are from the one where company has not received second and final call money. And total number of shares on which second and final call money was not received were 2,500. So out of these 2,500, only 500 have been forfeited. This is what this means. Because the company has forfeited 1,500 shares, including those on which first call was not received, and the shares on which first call was not received were 1,000. It means remaining 500 are those on which second and final call was not received. So this is how the company has reissued 1,500 shares. So we have to calculate the amount of capital reserve, for which we will make a table. Number of shares forfeited, share forfeiture amount, number of shares reissued, forfeiture amount of reissued shares. And this was forfeiture amount of forfeited shares. So there are two types of shares which have been forfeited. One, those on which first call money was not received, that is 1,000 shares, and the other 500 on which second and final call money was not received. So share forfeiture account of these 1,000 shares when they were forfeited is rupees 4,000. And the one, and here the company forfeited 2,500 shares on which final call money was not received. So for 2,500 shares, the forfeiture amount was 15,000. This 15,000 amount is of 2,500 shares. It means for one share it is rupees 6 per share. So for 500 shares it would be 3,000. That is 500 into 6. This is number of shares forfeited and reissued. So we do not require these two columns here. So total forfeiture amount of forfeited shares is 7,000. And discount given by the company on reissue was 6,000. So the amount that will go to capital reserve is rupees 1,000. So here the amount would be 1,000. And the narration here would be being profit on reissue of 1,500 shares transferred to capital reserve account. And this profit is capital profit, that is the profit of capital nature, and that is why it would be transferred to capital reserve. So with this, guys, our this question is also done. The next question is of again shares, where Savi Limited has forfeited 50 shares of rupees 100 each. These shares were issued at a premium of 10%, on which allotment money of rupees 30 per share, including premium, and the first and final call money of rupees 40 per share were not received. What is the minimum amount per share at which the company can reissue these shares? So this is what we have to find here. Now, minimum amount per share at which the forfeited shares can be reissued is the one that is arrived at after deducting the maximum discount per share from the face value of shares. So here face value is rupees 100, and maximum amount of discount is the amount of forfeiture per share. So here, out of share of rupees 100, allotment money of 30 and first and final call of 40 has not been received, means 70 has not been received. So the received amount here is, and this 30 of allotment includes the premium at the rate of 10%. So premium 10% of 100 is rupees 10. It means premium per share is rupees 10. So on this 30 of allotment, premium of rupees 10 is also added. It means the allotment face value is rupees 20 and first and final call is rupees 40. So 20 plus 40 is 60. It means that the application money was rupees 40 per share. And that has been received on these 50 shares. and that has gone to share forfeiture account. So 40 rupees per share is the maximum amount that can be given as a discount on reissue of these shares. It means the minimum amount that can at which the company can reissue these shares is rupees 60 per share. So here the answer is rupees 60 per share. Allotment money is 20 plus 10. Premium per share is 10% of face value, that is rupees 10. It means face value of allotment is 30 minus 10, that is 20, and face value of first and final call is 40, means face value of application is 100 minus 20 of allotment minus 40 of first and final call, that is rupees 40. And this 40 has been received by the company, and this 40 has gone to share forfeiture account. So maximum discount that can be given on reissue of shares is 40. It means the minimum amount per share at which shares can be reissued is 100 minus 40, that is 60. So rupees 60 per share is the answer of this question. So we are done with this question as well. Now we have section B. Now here we have question number 11, which says that we have to choose correct option in subpart 1 and 2. So, and in subpart 3 and 4 we have to answer the questions. So this part number 1 says that, okay, here we have to find a difference between total assets and current liabilities. Total assets minus current liabilities is only shareholders funds and non-current liabilities, and they both together constitute or make capital employed. So the correct answer for this is capital employed. Now the next one is, while preparing cash flow statement, which of the following will be classified as a company by a company as its cash outflow from investing activities. So it is investment in government securities, because when we purchase government securities, it is part of investing activities, and that causes outflow of cash. Investment in bank deposits having maturity of 6 months, and the R&S are proceeds from redemption of liquid mutual funds units and proceeds from bank deposits. They both are inflow of cash. We have to answer about outflow of cash. Since investment in fixed deposit has maturity of 6 months, it means it is part of current assets. However, these current assets are not marketable, and that is why it would not be part of cash and cash equivalents, but would be part of investing activities. So answer of this would be P and Q. Now, third part, question number three, sub question number three. A company has a quick ratio of 1.8 to 1. We have to mention whether this ratio will improve or will reduce or will not change after it sells a machine worth rupees 1,20,000 at a loss of rupees 30,000. So when we sell machine, there would be inflow of cash or cash equivalent, and that will increase our quick assets. Even though machine is sold at a profit or at a loss, it has nothing to do with quick ratio, because quick ratio is a ratio of quick assets and current liabilities. So the only thing that will change out of these two, numerator and denominator, is quick assets, and that will increase because of sale value of the machine. And because of this, the ratio will improve. Now, state whether creators would prefer lending to a company when a high debt equity ratio or a low debt equity ratio. So we have to tell whether the creditors or lenders would prefer to lend a company whose debt equity ratio is high, or when it is low. So when debt equity ratio is high, it means debt is more than it means debt is more than equity, or debt is quite more, and that involves risk of financing for the company. That is known as financial risk. So they would prefer to lend to the company only when there is low debt equity ratio, because with low debt equity ratio, financial risk of the business would be lesser, right? Now, fifth sub question, we have been given extract of balance sheet of Nova Limited, where we have been given share capital and securities premium on two different dates, 31st March 2023 and 31st March 2022. During the year 22-23, the company raised its share capital by issuing bonus shares to the shareholders at the beginning of the year in the ratio of 1:5. That is one bonus share for every five equity shares. The balance shares were issued for cash to the public. So, how many shares were issued for cash by the company? This is what we have to calculate. Okay, so on 31st March 2022, the number of shares were 5 lakh divided by 10, that is 50,000. Whereas on 31st March 2023, it has become 8 lakh divided by 10, that is 80,000. Means number of shares raised during the year 2022-23 were 30,000. Now this includes bonus shares, and bonus shares have been included in the have been issued in the ratio of 1:5. So it means for every 5 share, one bonus share was issued. And here we have total 50,000 shares. So for 50,000 shares, 10,000 bonus shares were issued. It means the shares which were issued in cash were 20,000. So total number of shares issued by the company in 2022-23 were 30,000. How come? 8 lakh was the capital at the end of the year, and at the beginning it was 5 lakhs. And this is divided into shares of rupees 10 each. This is how we have got number of shares as 30,000. At the beginning of the year, the share capital was 50,000 shares. Number of shares were 50,000. That is 5 lakhs divided by 10. So the number of bonus shares issued during 2022-23 were 50,000 divided by 5. That is 10,000 shares. Using the ratio 1 is to 5. It means number of shares issued for cash were 30,000 minus 10,000, that is 20,000. 30,000 I took from here, which is the total number of shares issued by the company during the year 22-23, out of which 10,000 shares were issued as bonus shares. It means the remaining 20,000 shares were issued for cash. Now, in this question, we have to prepare. Okay, we have been given comparative income statement of Violet Limited for the year ending on 31st March 2023 and 31st March 2022. We have to present the comparative income statement in its complete form after calculating the missing information represented by this. So revenue from operations here would be, okay, let's make comparative income statement. Particulars 31st March 2023, 31st March 2022, absolute change and percentage change. So here we have RFO, revenue from operations. Earlier it was 7098 and it has changed by 364, means it has increased by 364. So now it would be 7098 plus 364 That is 7,462. Now, percentage change would be 364 divided by 7098 into 100. That is 5.12. The next item that we have is expenses. Expenses are 8998 here, 7931 here. Substitute change is 8998 minus 7,931. That is 1,067. So percentage change would be 1,067 divided by 7,931 into 100. That is 13.45. So net profit would be here 7,462 minus 8,998. That is 1,536. And here it would be 7,098 minus 7,931. This was in loss. That is why I'm keeping this in parentheses and brackets. Now here again we have loss 7,098 minus 7,931. That is 833. Again loss. So absolute change is 1,536, which is in minus, being loss, minus 833. That is minus 1,536 plus 833, which is in minus 704. 703. Yeah. So now here the absolute change is minus 703 divided by minus 833 into 100. That is 84.39%. So this is how our comparative statement, income statement is done. Next question is we have some information of Neon Limited, and we have to give the answers for the questions given below in relation to the cash flow statement of the company for the year 2022-23. So we have been given certain items like provision for tax, 10% debentures, unclaimed dividend, plant and machinery and land, and dividend proposed in the years 2020, 21, 22 and 22, 23 were 30,000, 40,000 respectively. Now, during the year 22-23, the company has provided for tax rupees 75,000, issued 7% debentures at a discount of 5%, and purchased plant and machinery for rupees 40,000. So we have to find the amount of tax paid by the company. So tax paid is 50,000 was the opening balance of provision for tax, and this year the company has provided for rupees 75,000. So total liability of the company for tax is 1,25,000. However, at the end of the year, the liability was only 80,000. So 125 minus 80, that is 45,000 is the amount of tax paid by the company. Now the next question is you have to give the reason for the opening book value and closing book value of plant and machinery remaining the same despite the purchase of a machine during the year. Okay, so here we have been given same value of plant and machinery at the beginning as well as at the end of the year. Though during the year a plant and machinery was purchased for rupees 40,000. How it is so? How it is possible? It is possible because of depreciation. So plant and machinery increased by 40,000, but during the year the same amount was charged as depreciation. That is why its closing book value is again 1 lakh what it was at the beginning of the year. Now, what is the inflow of cash from issue of 7% debentures? Company has issued 7% debentures at a discount of 5%, and here we have been given book value of debentures. It means debentures of 5 lakh have been issued by the company at a discount of 5%. So 5% of 5 lakhs is 25,000. It means the net proceeds from issue of debentures is 5 lakh minus 25, that is 4 lakh 75,000. So inflow from issue of debentures is 4 lakh 75,000. Now we have to give companies outflow of cash for dividend paid to shareholders. We do not have unpaid dividend here, but yes, we have unclaimed dividend. At the beginning, there was nothing, but by the end, there are 6,000 rupees. There is no unpaid dividend. We know that dividend proposed in a year is not appropriated nor paid in that year. Rather, it is appropriated and paid in the next immediate next accounting year. It means during the accounting year 22-23, dividend of 21-22, that is rupees 30,000 was appropriated as well as paid. However, since at the end of the year the unclaimed dividend is rupees 6,000, it means the dividend paid by the company during the year 22-23 was 30 minus 6, that is 24,000. So answer to this question would be 24,000 rupees. Now Fifth part, we have to give reason whether Neon Limited will consider the decrease in the amount of land as an operating activity or as an investing activity while preparing its cash flow statement. So land value is decreasing from 6 lakhs to 4 lakh 50,000. We know that land is not depreciated. It means there is sale of land and that is part of investing activity. So decrease in the value of land would be shown as an item of investing activity while preparing cash flow statement. So this is how this question is also done. Now the next question, we have been given balance sheets of Halogen Limited. With this, we have to prepare cash flow statement for the accounting year 22-23. In balance sheet, we have share capital, we have reserves and surplus, and there is only one item in reserve and surplus, that is statement of P&L, means balance in a statement of P&L. We have 15% debentures as long-term borrowings. We have provision for tax as short-term provision. In assets, we have property, plant, and equipment, for which note number 1 is there, where we have plant and machinery as well as its accumulated depreciation balances for the 2 years. Then we have current investments and cash and bank balances. In additional information, it is given that additional debentures were issued on 1st October 2022. So here debentures have been issued. Earlier they were 4 lakhs, now they have become 6 lakhs. It means debentures with the face value of 2 lakhs were issued during the year 22-23, and they were issued on 1st October 2022. This date will help us to calculate interest on debentures, which carry interest at the rate of 15% per annum. Company has sold plant and machinery, the book value of which was 120, and total depreciation on that was 38,000 for rupees 50,000. Okay, so let's do this question where we have to prepare cash flow statement. Here I am calculating interest on debentures. So earlier we had debentures of 4 lakhs. On 4 lakhs at the rate of 15% for 6 months, we will calculate interest. Why? Because new debentures were issued on 1st October 2022. So from 1st October 2022 till 31st March 2023, we have period of 6 months. And from 1st April 2022 till 30th September 2022, we have period of again 6 months. So initially we had debentures of 4 lakhs on which interest would be charged for 6 months. And after that debentures became of 6 lakhs on which again interest would be charged for the remaining 6 months. It is 60,000 and half of that is 30,000. And here it is 90,000 and half of that is 45,000. So total interest on debentures is 75,000. So these are our working notes. Now the next working note we'll make for the sale of plant and machinery, where we have been given book value. Now, book value is not original cost of plant and machinery, but it is written down value of plant and machinery. So, written down value of plant and machinery, which was sold during the year 2020 to 23 was 1,20,000. This is written down value, I repeat. And total depreciation charge on this plant and machinery is 38,000. And this has been sold for rupees 50,000. WDV means original cost of the asset minus total depreciation charged on it. So I write here original cost less accumulated depreciation, that is total depreciation. This will give us written down value of asset, the asset that has been sold. Now accumulated depreciation is 38,000 and written down value is 120. It means original cost of the machinery which has been sold is 1,58,000. And this has been sold for rupees 50,000. It means there is loss on sale of rupees 70,000. I hope you have got this. 158 we have got as 120, that is WDV plus total depreciation charged, and this is how we have got original cost. It means during the accounting year 22-23, a machinery which had original cost of 158 and on which total depreciation charged was 38,000 was sold for rupees 50,000. So on sale there is loss of 70,000. Now with this information we make profit and loss account, plant and machinery account and its accumulated depreciation account to derive other information that would be used by us for cash flow statement. So first I write opening balance of plant and machinery, and that is rupees 9 lakhs, and closing balance is 7,42,000. The same I do for accumulated depreciation. So opening balance of accumulated depreciation is 2 lakhs and closing is 2 lakh 62. Now, as per the information given to us, the plant and machinery which was sold during the year was charged with total depreciation of 38,000 till the date of its date, since when it was purchased. Since it has been sold, its accumulated depreciation would be removed from accumulated depreciation account and would be transferred to plant and machinery account. So here we will have 38,000, and this 38,000 will go on credit side of plant and machinery account. Now on the credit side, we will also write cash or bank for the sale value, that is 50,000 rupees, and also loss on sale, that is 70,000. So total of these three amounts is 120 plus 38, that is 158, which is original cost of the plant and machinery which was sold in 2022-23. So now 120 plus 742, sorry, 158 plus 742 is 9 lakhs. And this is how this account, plant and machinery account, has got closed. Now we will close accumulated depreciation account. So total of debit side is 3 lakhs. So same total I am writing on the credit side. With this, we have got balancing figure of rupees 1 lakh here, and that is nothing but depreciation charged during the year on plant and machinery. Now, by making the two accounts, we have derived some information which will be used by us in our cash flow statement. One of the information is depreciation that would be used to calculate cash flow from operating activities. This is a non-cash operating expense, and you know what to do with that. It would be added to profit before tax. Loss on sale would also be added to profit before tax, and the sale value is inflow under investing activities. So let's make cash flow statement now. So I have pasted this here, this entire working notes, and I'm removing it from here. Now we make cash flow statement. For the year ended 31st March 2023. The very first thing is that we write is cash flow from operating activities. And in that, the first item that we write is profit before tax. Now here, statement of P&L balance at the end of previous year was 20,000 in negative, means it was accumulated loss. And at the end of the current year, that is on 31st March 2023, it is 1,06,000. It is positive, it means it's a surplus. We do not have any other item in reserve and surplus, that is general reserve, DRR, or any other reserve, and that is why nothing has been transferred from profit to any reserve account, nor we have any information about any other item of appropriation of profits, that is dividend. So our profit before tax would be balance of statement P&L as at 31st March 2023, that is 1,06,000 minus balance in statement of P&L as at 31st March 2022, which is minus 20,000. So this would be 1,06,000 plus 20, that is 1,62,000. So our profit before tax for this year, for the year 22-23 is 1,62,000. Now to this we will add all non-operating, we will adjust all non-operating and non-cash items. First, depreciation on plant and machinery, and that we have already calculated as rupees 1 lakh here. Then add loss on sale of plant and machinery, that is rupees 70,000, which has gone to P&L account and has decreased the profits. So now we will add it back to the profit before tax. We will also add interest on debentures, which we have already calculated for the year, and that is 75,000 rupees. This has gone to P&L and has decreased the profits, but since it is an item of financing activity, it would be removed from operating activities. And for that, we are adding it back to the profit before tax. To calculate profit before tax, I missed here one item, that is provision for tax, the opening balance of which was 70,000 and closing is 50,000. Now, we do not have any other information about tax, that is how much tax was provided during the year and how much was paid. And in that case, we will assume that the tax liability at the end of the previous year was paid during this year, and the liability which is there at the end of the year as balance in provision for tax account is the liability of the current year. So tax provided for the year is 50,000, whereas tax paid during the year is 70,000. So tax provided would be added here, and that is rupees 50,000. Now with this, our profit before tax would be 2,12,000. Okay, so I have done the correction here of profit before tax. That's it. So now the amount that we have got is cash flow from operating activities before changes in working capital. And that is 3,82,000 and 450 and 4,57,000. Now, to this amount, we adjust the changes in working capital. And for that, we need to see the items of current assets and current liabilities. In current liabilities, we have only one item, that is provision for tax, which is taken care of differently to calculate profit before tax. And the amount of tax paid during the year, that is 70,000 in our this example, in our this question, that is deducted from cash flow from operating activities at the end. So we do not have any item of current liabilities here, which would be part of changes in working capital. In current assets also, we have current investments. In absence of any information, we will assume that these current investments are short term and fully marketable. And that is why we will treat these current investments as part of cash and cash equivalents. Other than these current investments in current assets, we do not have inventories, we do not have trade receivables, we do not have prepaid expense or accrued incomes. So we do not have any item that becomes part of changes in working capital in this question. So this amount itself would be cash flow from operating activities after changes in working capital. And from this, we will subtract tax paid during the year, and that is the tax liability of the previous year, that is rupees 70,000. It means net cash flow from operating activities which is marked as small a is 457 minus 70, that is 3,87,000. And this would be shown in the outer column, 3,87,000. Now, cash flow from investing activities. So here in investing activities, we have items that fall under non-current assets, and we have only one item here, that is property, plant, and equipment. And the flow of cash related to plant and machinery is only one, that is sale of machinery, plant and machinery for rupees 50,000. We have no purchase of plant and machinery during the year at all. So here we'll write sale of plant and machinery amount is 50,000. This is the only item falling under investing activities. And this only will become net cash flow from investing activities, represented by B. And will come in outer column. Now, cash flow from financing activities. Now, for financing activities, we look at the liabilities side. In liabilities side, we have share capital. Earlier it was 4 lakhs. Now, by the end of 31st March 2023, it has become 4,50,000. It means during the year we have issued additional shares with capital of rupees 50,000. Since each share is of rupees 10, it means number of shares issued by the company are 5,000. 50,000 divided by 10, 5,000. And we do not have any additional information about issue of shares. So we'll assume that these shares, we will consider that these shares were issued at par, because there is no information about premium under reserves and surplus. Apart from this, long-term borrowings have also increased. That is, the debentures value has increased from 4 lakhs to 6 lakhs. It means additional debentures have been issued. And in additional information, we have been given only one point about these debentures. That is, debentures were issued on 1st October 2022. So, as a matter, there are only two items that are part of financing activities. One is net proceeds from issue of shares, that is 50,000. And second is net proceeds from issue of 15% debentures, that is 2 lakh. One more item will come here as outflow, that is interest paid on debentures, which we have already calculated as 75,000. This is outflow of cash under financing activity. So, net cash flow from financing activities represented by small c is 1,75,000. The net of these three figures. So with this, we have calculated the flow of cash under the three activities: operating, investing, and financing. The total of the three is 6,12,000. Whereas here the flow of cash is 7,26,000 minus 1,50,000. 576. Okay, here, yeah, here I have done a mistake. It is 1,06,000 plus 20, that is 126, plus 50, that is 176. So it would be 276, then 70, that is 346, 346, 4,10,000 and 4,21,000. Yeah. 421 minus 70 is 3,41,000. 3,51,000, I'm sorry. Here the amount is 3,51,000. So here I did a calculation mistake. I'm sorry for that. Now the net cash flow from the three activities is 6,12,000. To this we add uh, it would not be 6,12,000 now since I have changed this amount. So 351 plus 50 is 4,01,000, 4,01,000, 5,01,000 and 5,76,000 it would be. Yeah. Now opening balance of cash and cash equivalents is sum total of current investments and cash at bank at the end of previous year, that is 1,50,000, 10,000 plus 1,40,000, that is 1,50,000, and that amount should be equivalent to the closing balance of cash and cash equivalents. So the total amount here is 7,26,000, and our closing balance of cash and cash equivalents is 256 plus 470, that is 7,26,000. This is how our cash flow statement is made, and it is matching with the closing balance of cash and cash equivalents. Now the next question. Here we have to calculate preference dividend paid by the company. We have been given net profit before tax. We have been given equity share capital where the face value is 10 and market value is rupees 15. So capital at its face value is rupees 40 lakhs. Tax rate is 30% and earning per share is 2.75. So let's calculate preference dividend paid by the company. We know that the formula of earning per share is profit after tax minus dividend to preference shareholders upon number of equity shares. And earning per share given to us is 2.75. Net profit before tax is 20 lakhs. So net profit after tax would be 20 lakhs minus 30% of 20 lakhs, that is 20 lakhs minus 6 lakhs, that is 14 lakhs. Number of equity shares are 4 lakhs. That is 40 lakhs divided by 10, 4 lakhs. So now we'll put the values here in this formula. So profit after tax is 14 lakhs minus dividend to preference shareholders upon 4 lakhs, that is number of equity shares. We can also write this formula as 2.75. We can also write this equation as 2.75 into 4 lakhs is equal to 14 lakhs minus dividend to preference shareholders So 2.75 into 4 lakhs is 11 lakhs is equal to 14 lakhs minus dividend to preference shareholders. So dividend to preference shareholders is 14 lakhs minus 11 lakhs, that is rupees 3 lakhs. So we have calculated dividend which was paid to preference shareholders. Now the next question. Here we have to calculate current ratio from the extract of annual report of 21-22. We have been given opening entry in inventory of consumables, that is raw materials, closing inventory, opening inventory of finished goods, closing inventory of finished goods, current assets, that is other than inventory of consumables and of finished goods and work in progress, and current liabilities. So here we have to calculate current assets. Why? Because the value given to us of current assets 3,229.23, which is in rupees millions, does not include inventory items, that is inventory of raw material, finished goods and work in progress. And to this we will add only closing inventory. So current assets including inventories would be 3,229.23 plus closing inventory of finished goods and work in progress, that is 197.24, plus closing inventory of consumables, that is raw materials, 389.85. So this is 3229.23 plus 197.24 plus 389.85. That is 3816.32, 3816.32. So now we can calculate current ratio as current assets upon current liabilities. Current assets are 3816.32 and current liabilities are 936.52. That would be 4.07. So this is how we have got current ratio also of this question. Now the third one, we have been given return on investment as 20% of a company and its capital employed is 50 lakhs. Now we have to give the formula to calculate return on investment. We just have to write the formula and we have to calculate the missing third component, which is part of calculation of return on investment. So let's do that. Return on investment is profit before tax and interest, which is nothing but operating profit, divided by capital employed. And return on investment here is 20%, and capital employed is rupees 50 lakhs. So here I have written the formula of return on investment as asked in A part of this question. Now the B part, this is into 100. Here we multiply 100 to calculate return on investment in percentage, and the value of that is 20. Profit before interest and tax we have to find out. This is the missing element or component. And capital employed given to us is 50 lakhs into 100. So profit before interest and tax is 20 into 50 lakhs divided by 100. That is 10 lakhs. So profit before interest and tax here is 10 lakhs. We are done with the third part also, that is this one, this question. Now the fourth is where we have to calculate working capital turnover ratio, and we have cash, short-term loans and advances, inventory, trade payables, cost of revenue from operations, gross profit on cost of revenue from operations. These items are given to us. Now we know that working capital turnover ratio is calculated as the ratio of RFO to working capital. That is revenue from operations or net sales to working capital. Now for RFO, we have cost of revenue from operations 12 lakhs and gross profit on cost of revenue from operations 25%. So with this, we can calculate gross profit. And by adding gross profit to cost of revenue from operations, we will get revenue from operations. So gross profit is 25% of cost of RFO, that is 25 upon 100 into 12 lakhs, that is 3 lakhs. So RFO is cost of RFO, which is nothing but cost of goods sold plus gross profit, that is 12 lakhs plus 3 lakhs means 15 lakhs. So if RFO is 15 lakhs. Now, to calculate working capital turnover ratio, we require only one thing, that is working capital, and for that we have been given cash, inventory, short-term loans and advances, and trade payables. So here our current assets, to calculate working capital, we need to have current assets and current liabilities. In current assets, we will have the two items, that is cash and inventory. And in current liabilities, we will have short-term loans and advances and trade payables. So current assets is equal to cash, that is 10 lakhs, and inventory, that is 2 lakhs, that is 12 lakhs, and current liabilities is short-term loans and advances 3 lakhs, and trade payables 5 lakhs, that is 8 lakhs. Short-term loans and advances I am considering as liability and not as an asset, because usually companies do not give loans and advances, they take loans and advances until and unless it's a financing company or investing company. So now we have got working capital, that is current assets minus current liabilities, 12 lakhs minus 8 lakhs, that is 4 lakhs. So our working capital turnover ratio is RFO upon working capital, and RFO here is 15 lakhs divided by working capital 4 lakhs, that is 3.75 times, or 3.75 is to 1. It means RFO is 3.75 times of working capital. So we are done with this question as well. And with this, our entire question paper is solved. The question paper was not very complex, very difficult, but yeah, of course, it was lengthy. It was lengthier in the sense that lot many calculations were involved into it. I will appreciate that it also tries to cover most of the concepts. I will also say that the question paper was not straight. The questions were not straight. Like here, if you see, instead of asking to calculate earning per share, students have been asked to calculate preference dividend. Similarly, here they have been given opening inventory of raw materials as well as finished goods. Whereas when we calculate current ratio, we take all the items of current assets and current liabilities as at the end of a particular accounting year. So opening inventory has no use here. Here again, instead of asking students to calculate return on investment, they were asked to calculate the missing component, that is profit before interest and tax. And in the last one, working capital turnover ratio, it was little simple question. The only confusion which students may have is how to treat short-term loans and advances. So, short-term loans and advances, in absence of any specific information about the company whose ratio is has been asked to us, should be treated as a liability item and not an asset item. Why? Because companies other than investing and financing companies do not usually give loans and advances, rather they take loans and advances. Now, if I talk about cash flow statement, it was straight question. The only thing where students may confuse is about this book value, because usually what they practice, what they have practiced from different sources, in most of that, here instead of book value, the cost is given of that asset which was sold during the year, right? But here the terminology used is book value, and book value actually is written down value. So I believe that some of the students would have got confused with this. Now this question, here one has to calculate, students have to calculate the amount of tax paid by the company, and for that provision for tax balances of the 2 years are given, and tax provided for there is also given. So this is not very difficult question. Why? Because students would have practiced for it, because it is very common across all the cash flow questions. Now the second subpart is about how value of opening and closing balances of plant and machinery can be same. That is also easy. Students understand that there is depreciation on these tangible fixed assets. Then inflow of cash from the issue of 7% debentures. That is also not difficult. This could have been solved by considering the discount of 5% given on issue of debentures. Payment of dividend, that may be a little difficult for those students who have not practiced enough about proposed dividend and they do not know when dividend is appropriated and paid. And decrease in the value of land, the fifth subpart of this question, that is not difficult. Students understand this. Now, question number 12, where one has to find the missing values and have to make comparative income statement, though we have already been given format of comparative income statement here. So this question is more about calculations, which is not difficult. And this question number 11, in subpart 1, this would have been a little difficult for those students who have not practiced or who do not have knowledge of determining capital employed with the two approaches, liabilities approach and assets approach. Subpart 2, where one has to find cash outflow under investing activities. Some students might have got confused whether investment in bank deposit should be taken as investing activity or should be treated as part of cash and cash equivalents, because these bank deposits are getting matured 6 months, within 6 months. However, this bank deposits would not be part of cash and cash equivalents but would be part of investing activities. Why? Because cash and cash equivalents include only those instruments, those investment instruments which are of very short term and which are readily marketable, and the one that can be liquidated within a very short period, that is up to 3 months. Since here maturity is 6 months, that is why bank deposit would be part of investing activities. Now, the third subpart of this question is impact of sale of machinery on quick ratio. That is easy one. It will impact only quick assets. Now, reference of creditors lending a company when it has high debt equity ratio and when it has low debt equity ratio. Now, here the students might have been unable to answer this question if they do not understand the intensity of risk involved in a company which has high debt equity and the one which has low debt equity. In subpart 5 of this question, one has to determine number of shares issued for cash. Students again would have faced little difficulty to solve this question if they do not understand about the concept of bonus shares and they do not know how to calculate number of shares issued as bonus shares with the given ratio. Now, this question was of issue of shares, where forfeiture and reissue is there. But the question is very straight as because there is no oversubscription, there is no pro rata allotment, and there is no premium. So, students who have practiced enough with the questions of issue, forfeiture, and reissue of shares, for them this question would not have been difficult. Question number 10 is also a straight question. Here also we do not have pro rata allotment, and this question rather is of call scenarios and call scenario advance along with interest on call scenarios. So if students have practiced this kind of questions, for them it would have been very straight and easy question. Now the other question here is of partnership fundamentals. Now here one has to determine opening capital balance of partners. Usually students practice questions where they make capital accounts starting from opening capital and reaching towards closing capital, but here it is not so. Yet I believe that those who know where to put the items given here like IOD, salary, commission, for them it would not have been difficult. Yes, students might have mistaken if they do not know where to put interest on loan charged to a partner. Apart from that, passing closing entry for interest on loan, if students know this part, then they would have solved the other part very easily. Now, this question is again of partnership fundamentals. However, here we have permanent withdrawal, and with that, calculation of interest on capital becomes little difficult. So, those who know how to do that, for them it would have been easy. Otherwise, it would have been little confusing. Again, calculation of commission payable to Tanuj might have been little difficult if students have not practiced enough. Rest is not difficult in this question. Question number 8 of other than Shiv, where there is dissolution, students have to prepare partner's capital account. The only difficulty I found in this question, which students would have faced, is calculation of furniture amount. Rest all is very straight and easy. In this question of Mitu and Ritu, which is a question of admission, this question is more about treatment of accumulated profits or undistributed profits, that is reserves, where some reserves are not to be distributed and some are to be distributed. I think students would not have faced any problem in it. Now, before this question, question number 7, again of admission, where instead of giving us value of goodwill, new partners share in goodwill is given. This C part, that is bills payable rupees 20,000 to be honored by Sujoy, for which he is not to be reimbursed. Some students might have mistaken here. And those who do not know capital adjustment, for them also this subpart D would have been difficult. Rest is not difficult here at all in this question. The question again is a straight question. Now in question number 6, we have been given a extract of balances, that is extract of ledger of a company. And one has to make notes to accounts of share capital. Though the net value of share capital is already given here, that is 12 lakh 20,000. But how to reach 12 lakh 20,000? That one has to show in notes to accounts of share capital. And here we have call scenarios. And out of the defaulting shares, only some have been forfeited and not all. So this might have created little problem for students. Calculating short-term borrowings, current assets would not have been difficult for students. And amount of property, plant and equipment would also not would have been difficult. Why? Because plant and machinery and its accumulated depreciation is given to us. So this subpart C of this question asks us to calculate the amount of property, plant and equipment, but the question does not specify whether this amount should be calculated for balance sheet purpose or for some other purpose. I believe that the question actually meant that the value of property, plant, and equipment should be for balance sheet purpose, and that is why the answer of this should be given as plant and machinery at cost less accumulated depreciation on it. That is rupees 5 lakhs. So the question should be really very clear about what exactly is desired from students, is expected from students. Now, this question is about goodwill valuation and also calculation of new partners capital contribution who has been admitted in the firm. I do not find this difficult for those who have practiced it, because calculating goodwill is quite easy here. We do not have any adjustment related to profits or loss given to us here. But this question is about to pass entries for redemption of debentures, including entries for interest on debenture redemption investment. Here we have TCS, that is tax collected at source by the bank on the interest payable by it to the investing company, that is Resorts Limited. Rest all is easy, straight. Now here one has to prepare debenture holders account and DRI account. This 101% again is not difficult. Why? Because it shows that the investment was sold at a profit of 1% on its cost. The amount of DRR given to us here has no use actually in this question. This is again a question of debentures where one has to make loss on issue of debentures account and 6% debentures account. Again, a straight question. I do not see any complexity in it. Now, this question is of partnership, retirement. This is more of calculating and preparing Kamal's loan account. The calculation is about interest payable to Kamal because he has been paid half of his capital after a year from the date of his retirement. Not difficult. Now, this question is of death, where we have interim period and its profitability. And we have to prepare here interim balance sheet. Most of the students do not practice to prepare interim balance sheet in the questions of death. So for them, this would have been difficult. Otherwise, it's a straight question. Now, 1 mark questions. So here we have to pass entries for interest as well as for principal amount of debenture. Not difficult question. In the ninth question here, we have to find partners capital contribution, the new partners capital contribution, which is based on the combined capitals of old partners. Not difficult question. Now, eighth question, I already told that I already discussed in the earlier part of this video that most of the students would have found it little difficult. Why? Because they know the heading or subheading, but they do not know the other one. So most of the students would have answered this with only contingent liabilities and not contingent liabilities and commitments. But I think that the ISC council would be quite lenient about this because knowing that students may not have in-depth knowledge of this particular item. Here, one has to calculate rate of discount given by the company for which securities premium balance is given. Not difficult for those who understand this. Now, sixth question, realization of payment from data for that journal entry has to be passed. Also not difficult. One has to deduct the discount, keeping in mind the due date and the date of payment. Fifth one is very easy. Most of the students understand when revolution account is made and when realization account is made. A fourth one, here one has to calculate subscribed capital. This might have been little difficult for students. Why? Because here there is non-payment on some shares and they have been forfeited later, and out of that some have been reissued. The students might have confused, most of the students might have confused whether amount of forfeited shares should be part of subscribed capital or not. Now, question number three. So here one has to mention the correct order in which a partnership firm makes payment on its dissolution. This is not difficult question at all, except the S part here, that is surplus divided amongst the partners in their profit sharing ratio. This might have been a little confusing. Some students would have understood this surplus as realization profit, but others, those who are clear with their concept, they understand that this surplus is surplus of money available after making all the payments up to partners' capitals. Now, second question is again of debentures. Again, this would have been little difficult for those who do not understand what is redemption out of capital and what is redemption out of profits. Now, the first and the last one here for our discussion. WCR balance is given and claim on account of workman compensation is also given. So this is a very easy question. So this is how we have reviewed and solved the entire question paper, and I believe, in my belief, the question paper was not very complex. Few questions had little complexities, which I have already discussed and explained. But yeah, definitely question paper was lengthy as far as calculations are concerned. So calculations made the question paper very lengthy, very watertight. Students, I believe many students would have missed few questions or some calculations. So for the students of class 12th, for the academic year 24-25 should keep this in mind, and right from the beginning of the academic year 24-25 they should practice enough so that they could maintain good speed while writing examination paper for such question papers.